Okay, we have enough to start. So, Assalamu alaikum, everybody, and thank you for joining us in today's webinar for the 2025 Market Outlook. Inshallah, like Irfan said, we do have quite a bit of material to cover, so we hope you do enjoy the conversation, and we'll have some time at the end for some Q&A as well for any of those who do have questions that you'd like us to answer. So myself and Irfan will be presenting today's session. Irfan is a portfolio manager at the firm, and I am also an associate portfolio manager, and we're both part of the investment committee. Just a quick disclaimer before we begin. I mean, it's general information. We always share this, but the information that we provide in this presentation is always subject to change, and it does not should not be considered as specific advice to any of the attendees. If you do have any specific questions regarding to your own situation or your portfolios, please do get in touch with us directly to discuss specifically with regards to your situation. So we'll just go over very basically about ShariaPortfolio Canada in general, especially for those who are new and joining us today. We'll go over a little bit about the US and Canadian monetary policy, after which we'll discuss some of the performance, and we'll go through some sector analysis. Irfan will then discuss a little bit about the global macro outlook, some hot topics, and our strategy for 2025. So for all of those who don't know, ShariaPortfolio actually offers professionally managed solutions. We're a wealth management firm focusing on helping Muslims achieving their lifetime goals without sacrificing on their personal values. We are Canada's only licensed portfolio management firm that's fully dedicated to Sharia compliance. We are a registered portfolio manager as well with the OSC, founded in 2003 in the US and founded in Canada in 2019, and growing really fast, alhamdulillah. We are partnered with the custodian Fidelity Clearing Canada, which is where your assets kind of sit with and are protected by as well. Now, let's just jump right into it. So, US and Canadian monetary policy. So as most of you probably know, the Canadian economy is significantly weaker than the US economy, especially during such periods. Despite cutting rates significantly more than its peers last year, the Canadian economy is still struggling from the restrictive policy that it did go through. The Bank of Canada has been cutting rates much faster than the Feds in the US, and that has weakened the Canadian dollar. And not only that, we're seeing the spreads between the US and Canadian fixed income yields at the widest levels we've seen in recent history. And this is likely to continue, given the Bank of Canada is still expected to continue cutting rates in 2025 at a faster pace than the US is. Of course, the US Feds are announcing their decision today for the next rate announcement, so we'll see and we'll keep our tabs up on what's happening with that as well. With regards to the US monetary policy, the good thing is that right now, at least the yield curve is pretty flat, slightly steepened towards the longer term horizon. In 2024, there were expectations of interest rate cuts, and that direction changed towards the mid of the year as new data came in suggesting a stronger economy than they thought. So we saw a lot of strong job reports, inflation data close to target levels, and that changed how the Fed was managing their monetary policy compared to what was expected of them from the beginning of the year. The implied Fed funds rate cuts actually moved from 150 basis points to less than 50 basis points by mid-year in 2024. And then it jumped back up to 100 basis points. Now, in 2025, there is a potential for a rate hike. Now, the Feds are very data dependent. So they go off making their decisions based on what they see on the monthly data that comes out. So there is a chance for a rate hike as well in 2025. And it's yet to be seen how that would definitely impact the market. Now, the flat to rising yield curve, as you can see in the chart above, it's going to be a key indicator of how the Fed will actually be effectively maintaining the economy, inflation, and the labor market imbalance. Should it become inverted, which is similar to what we saw in 2022, that may definitely indicate potential rate hikes to offset growth and other inflationary pressures. As you can see here, this is some data that was coming out towards the end of last year. And you can see how there were stronger numbers towards the end of 2024. For example, the unemployment rate actually ticked lower and PCE inflation numbers actually ticked higher. Core PCE also ticked a bit higher. And when unemployment did increase during the beginning of the year, consumer spending actually still stayed pretty strong. So these are some of the important things to keep in mind when trying to assess what the Fed may potentially do. And like I said, they're very data dependent in what they do. So they wait to see the data, and based on that, they do make their decisions. Now, by the end of 2025, the Fed is likely, so what you're seeing here is actually the Fed watch tool, which is a good indicator for the probabilities of where the target rate will be sitting by the end of the year. And around mid-2024, at that time, there was actually a 96.5 probability of seeing about a 1% in rate cuts by the end of 2024, which is where we were. End of year 2025 target rate probability suggests close to an 80% chance of seeing only, this is actually supposed to be 25 to 75 basis points in further rate cuts. That's the probability. Now, these change over time, of course, like I mentioned, as the data does come out. For example, for today's announcement, there's actually a 97 to 99% probability that the Feds actually hold. But what I'm sharing here about the 80% chance of probability of seeing a 25 to 50, 75 basis points in further cuts is by the end of 2025. So these are just some really important key points to have in your mind. Now, let's go a little bit deeper into how our portfolios actually performed and how the market in general actually performed in 2024. Before we get into that, just going to give, of course, for anyone who's new joining us today, we have a suite of different model portfolios that we manage for our clients based on the different risk profile and spectrum they're on, all the way from Sukuk, which is a very conservative model, moderate, kind of sitting in the middle, all the way to aggressive. And what you'll notice is the aggressive actually has a higher asset allocation towards equities compared to our more conservative portfolios, which have a larger allocation to Sukuks. Sukuks are actually the alternative to fixed income conventional style bonds, but they're Sharia compliant. So it's a Sharia compliant alternative fixed income asset class, which our clients do benefit quite a lot from. And we actually have a great fund, SPSK, which is actually one of the top global bond funds in the world. So this is just to give you a general idea of what our asset allocation generally looks like. Now, of course, these are subject to change and they're not always exactly as you see here, but it gives you a good idea of the ranges that we sit within. One other thing that I'd like to mention is, of course, we are still close to all-time highs. And a lot of the times, as investors, we go through that debate in our mind of, should I invest now? Should I not invest now, right? And the best time to invest was always yesterday, especially if you have a long-term horizon. Now, what this graph is actually showing you is what is the probability that the S&P 500 is actually higher following the year you're investing when you're actually at a market high. So let's say you're at all-time highs today. What's the chance that next year the S&P 500 is actually higher than where it is right now, considering the fact that you're in all-time high? So on a 1-year time frame, there's actually a 73% probability that the S&P 500 is even higher than you are at right now when you do invest at a market high. Of course, when you extend this time period to a longer time period, the probability sits more in your favor. It's up to 87%. So whenever you're investing, we have a very good webinar on this about why it's important to stay invested, why it's important not to time the market. So feel free to check that out on our website. But this is just to give you a general idea of why it's important to always invest, stay invested, and try your level best not to actually time the market, especially if you have a long-term horizon. Now, how did the S&P 500 actually perform in 2024? So the S&P 500 did 23.3%. This is the second year in a row where we actually had double-digit returns in the 20s, which is phenomenal. But let's go a little bit deeper into seeing how we actually performed compared to the S&P 500. And what we're going to use is, actually, before I get to that, so the S&P 500 did perform 23.3%. But what does this mean? Why did it actually perform 23.3%? The majority of the return actually came from a small group of companies, which represented a large portion of the S&P 500 gains. For example, if you look at the screen on the right, the chart on the right, 22% of the gains were actually from one stock, NVIDIA. And 33% of all the gains in the S&P 500 came from 6 companies. 45% of the total gains actually came from the other stocks. Now, the reason you're seeing it says 511 there is because companies come in and out of the S&P 500 during the entire year. But in general, it is the S&P 500. So at any one time, you'll actually have 500 companies. Despite 11 of these sectors actually delivering phenomenal gains last year, majority of the gains were led by the Mag 7, which is your regular Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. And like we mentioned, NVIDIA actually attributed towards 22% of S&P 500's gains. And a lot of these gains actually came from the AI theme, the topic of AI, how it introduces better economic growth, productivity within companies. And Irfan will discuss that a little bit when we're discussing the hot topic section. So a company like NVIDIA actually performed 171% in 2024, 171%. Now the S&P 500 is actually a cap-weighted index. So the larger the market cap of the company, the larger your weighting in the S&P 500. Now, how does this compare to our model? We're going to use the aggressive model because that's the closest we have to compare apples to apples with the S&P 500, given the asset allocation. Because the asset allocation in the aggressive model is about 90 to 95% in any given time. Sometimes less, sometimes a bit more. But in general, that's the closest we have to the S&P 500 because the S&P 500 is 100% equity. Now, our aggressive model performed 27.2% in 2024 compared to the S&P 500, which did 23.3%. Now, how did this actually come about? So what we're going to discuss very quickly is a couple of laggards and a couple of drivers. Laggards are basically the positions we held in our portfolio that actually underperformed the S&P 500. Okay, how we manage those positions, a little bit about those positions, and then we'll also go through the drivers, which is the different companies that actually performed really well compared to the S&P 500. And then I'll give you a quick snapshot of how that actually attributed towards the entire performance of our models in general. So here you have our 5 laggards. One is CRISPR Therapeutics, one is Transmedics, one is CNQ, which is Canadian Natural Resources, one is Adobe, and one is Qualcomm. So CRISPR Therapeutics, we actually got rid of this from our models because it is actually a company that was dropping and in price wasn't providing the returns that we did require, but at the same time, it did become non-compliant because at a certain point, it wasn't meeting the debt to market cap ratios that it needs to maintain in order to be Sharia compliant. So we did get rid of that in our portfolio, and we'll go through a little bit about the returns and how it affected our performance, and we'll do that for all of these. The next one was Transmedics. Transmedics, we actually currently still do hold, and they're in the healthcare sector. One of the reasons that they were actually lagging was their gross margins dropped, and they missed the earnings consensus. But as a company, it's still a very strong company. It has continued strong revenue growth of about 64% year over year. And earnings growth is still very apparent despite it missing its consensus. And it is still on track to achieve targets for 2028. Now, we still see this as a very strong company fundamentally, and that is why it's still a hold in our portfolio. Same thing with the Canadian Natural Resources. Canadian Natural Resources is a company that we actually hold because it also provides a very strong dividend. It is in the energy sector, which gives us some diversification in our portfolios. And it actually is a company that holds 32 years of energy equivalent reserves, whereas a lot of other commodity producers are actually having a depleting asset base where they actually need to go out and look for new reserves. It is still a strong company financially, very stable, and it actually has one of the most diversified asset portfolios in the entire energy production space. So that is very important. At the same time, they are planning to return 100% of the free cash flow that they generate to shareholders, which does actually increase shareholder value. So Canadian Natural Resources is still a hold, and we actually hold this across all models. Then you go to Adobe. Adobe actually had a pretty rough 2024. Financially, balance sheet wise, they're very stable, very strong company. They're also positioned for key acquisitions in the space. They haven't done any very recently, but that's something that's on the horizon. They also have a $25 billion share repurchase plan, which adds, again, shareholder value to any of its shareholders. They are using AI as well to enhance customer experience, increase the level of customer retention, and they actually have a very wide moat in the sense where it's very hard for someone who is very tied into Adobe services to actually move, especially in their digital media revenue segment, which is 70% of the revenues. Because the switching cost for someone to move from there to another company is quite high. And that's why they're actually focusing a lot more on customer retention to make sure that the switching cost is actually higher, which means they're able to maintain their level of customers. The last one, which was a laggard in our models, was Qualcomm. We actually got rid of Qualcomm for a couple of reasons. One was to solidify the losses that we did have in Qualcomm towards the end of the year, especially for accounts which are non-registered to have the benefit of tax loss harvesting. At the same time, Qualcomm is a company that was facing very extensive competition in that space because the semiconductor space is a very competitive industry right now, and it's also very volatile. Plus, we also, through the ETFs and other positions, we do have a pretty decent exposure to the semiconductor space in our portfolio. So it was important for us to look at this and one, solidify our loss, minimize the concentration in that area, as well as minimize the risk to a certain level as much as we could. So that's in general about the laggards in our portfolio. Let's talk a little bit about the drivers in our portfolio. One was Agnico Eagle Mines, one was Calmain, one was Vertiv Holdings, one was Arista Networks. We had a position in Bitcoin, as well as Taiwan Semiconductors. So let's go through Arista Networks first. Now, all of these companies are drivers because they did indeed outperform the S&P 500 in 2024, which adds to the value in our portfolio. So Arista Network is actually a leader in high-performance switches and supplies hardware for the main cloud titans such as like Microsoft and your large caps like Facebook, Meta. And for much of the year, they were actually outperforming NVIDIA, especially in the beginning. And they actually ended up the year 87% up. So right now, this is still a hold in our portfolio, and they're in the tech sector, but on the hardware side, which is also important to be able to diversify between the sector. So within the tech sector, for example, you may have semiconductor exposure, but at the same time, you may also have hardware exposure. Then you have Agnico Eagle Mines. Now, considering the materials sector actually didn't perform as well as other sectors in 2024, Agnico Eagle Mines actually did really well and did really well for our portfolios. They actually merged with Kirkland Lake Gold in 2022, in turn positioning itself as the industry's highest quality gold producer. They also have a very strong balance sheet, strong liquidity position, and they also generate a very strong cash flow, allowing it to pay down its debt and allowing it to invest in further projects for its expansion and growth in general. Agnico Eagle Mines is a hold in our portfolio. The next is Calmain, which is a very strong company. We did get rid of this because it reached our price target in 2024, and we had a very decent gain on this, about 77%. Still a very strong fundamental company with very strong financials, but according to us, it just reached a price where we had to liquidate and take our profits on that. And we may look into it further in the future if another opportunity arises within this space. Bitcoin is a company that is very technically driven, but also it has a lot of momentum when it does gain that. We actually got into Bitcoin at a very decent price, and we're still currently holding it. We bought it at a very, very key technical level, and we're sitting quite pretty on this position right now, but we are, of course, constantly maintaining and looking at this. Now, a lot of you may ask about the question of Sharia compliance. So we actually got Sharia compliance approval for Bitcoin as well as Ethereum. But right now, we only maintain a position in Bitcoin. And currently, we're still going to be holding that. The next one is Taiwan Semiconductors, which also performed really well last year, close to about 90%. And it is a very core position in the semiconductor space. They actually have very good gross margins that are improving, and they have the potential to reach above 60%, which is very healthy in that space. Now, they did face some production demand issues where there was an increased need for processors in modern cars. So a lot of the things that are manufactured today, a lot of the things that we use, so phones, cars, a lot of the electronic things that we do use require a lot of processors in order to be able to manufacture that. And Taiwan Semiconductors is actually one of the suppliers for those processors. So they actually hold a very key position in that space today. Vertiv Holdings is another one that we currently hold. They're actually in the industrial sector, but also on they support a lot of the tech companies. So they actually have a lot of exposure through the nature of their business to different sectors. So it's a very good company that's well diversified in where it's in with regards to the space it manages its business in. Now, they're a large player in the equipment space, and they generally provide cooling and power equipment to data centers to companies like NVIDIA, AMD, etc. Of course, with the news coming out a couple of days ago, there's a lot of different things that could potentially impact Vertiv Holdings, which is something that we're looking into very deeply, especially because a lot of their business comes from providing these equipments to companies that have a lot of data centers. So that's a space that's very volatile, number one. Number two, it's something that we need to keep the pulse on to always be aware of what's happening in that space and how that may affect the companies that we're holding in that space. They have very strong year-over-year earnings and revenue growth, and they're facing exponential demand up until now. According to Goldman Sachs, the server cooling market will actually grow at about a 60% compound annual rate up to 2026, which is the main line of business for Vertiv Holdings. And the share for liquid cooling in that market is supposed to more than double in the next 2 years. So that's again something that we're keeping our eye on, but it's something that performed really well in 2024. Now, how did these actually affect our model? Well, what you see here is just a view of how these actually contributed to the returns. For example, I won't go through all of this just to give you an idea, but for example, if you look at Arista Networks, right? We held it for the entire year. S&P 500 performed 23.3% in that year, and Arista Network did 90.5%. The weight that we had in our model for this was about 2%. So from the entire aggressive model performance of 27.2%, how much did Arista Networks actually contribute towards this? And that's about 1.81%. Now, if you look at the entire driver's view from the top 6 that I did mention, the total performance contribution towards this model is actually about 9.9%, which is actually phenomenal in this space, considering these are only 6 of the top holdings, which we consider were drivers of the portfolio. At the same time, you can look at our laggards and see, okay, with regards to the laggards, how much of that return was actually contributed to by the laggards? And you can see at the bottom there, it shows 2.67%. So the drivers actually contributed a lot more of positive alpha to our models compared to the laggards, which contributed a negative 2.67%. So our drivers contributed 9.9 positive, whereas the laggards actually contributed 2.67% negative. So being a net positive is actually a very good indication of how the portfolio was being managed last year. Now, just a little bit about sector analysis. Don't want to bore you too much, and then we'll shift this over to Irfan to go through the other things that are also very important to chat about. So what we're showing you here is what our sector weighting looked like during the mid-year in 2024 and how it changed towards the end of the year. For example, if you look at consumer defensive, we were actually underweight by 1.7% around mid-2024. And towards the end of the year, we were actually underweight by 4.3%. So more underweight than we were in the mid-year by the end of 2024. And this underweight and overweight is based on the S&P 500's sector allocation. So this is showing you how we actually compare to the S&P 500 with regards to how our portfolios are allocated accordingly to different sectors. Now, of course, things like financial services, most of the times we're always going to be underweight because it's almost very challenging to find something that's very good at the same time Sharia compliant in that space. Now, the S&P 500 has a pretty big allocation to the financial services sector, but we don't. And we, of course, ended up end up having to allocate these towards other different sectors. And the same thing also applies to a certain extent with regards to the communication services sector, with regards to finding something that's actually Sharia compliant and a good holding at the same time. Now, if you look on the left, this shows you the different sectors in the S&P 500, how they perform over the year. And then you'll see what is known as our weighting with regards to the S&P 500. So UW is underweight, OW is overweight. Now, what this is actually showing you is how we were mid-year compared to how we were end of the year. So with regards to communication services, we were underweight mid-2024, and we were still underweight end of 2024. If you look at the financial sector, it's the same thing there. Now, in some areas, we changed our positioning because we're looking for value in areas that do have potential upside, especially going into 2025. So if we're likely to see a sector performing very well in 2025 comparatively, we may have shifted slowly from underweight to overweight. Now, of course, this is still subject to change. But for example, you would have seen a slight shift away from the tech sector, where we were overweight and we actually ended the year underweight. And a lot of this is sometimes due to profit taking or just positioning differently based on market conditions as well. Now, like I mentioned with regards to the materials sector, despite being underweight in materials, if you actually look at materials here, they weren't one of the biggest performers sector-wise with regards to the S&P 500. But we had companies like Agnico Eagle Mines, which really outperformed and did well, which were actually a driver of one of our portfolios. So we were actually overweight materials, and we still do remain slightly overweight in the materials sector. So I hope I've given you a decent understanding of how our models have been managed in 2024, the market performance, as well as a little bit about the US and Canadian monetary policy. We will have time for questions at the end, so feel free to put them into the chat box and we'll definitely get through them. For now, I will pass it on to Irfan to go over our macro outlook and a little bit more about our strategy for 2025 as well. Thank you.
Thank you. Thank you very much. Assalamu alaikum, everyone. My name is Irfan, and portfolio manager and a member of investment committee for ShariaPortfolio Canada. And I think my colleague Zeeshan gave you a good run up on the portfolios, the way the portfolios are positioned in 2024, and what was the outlook, and what went wrong, and what went right, and how we think about the monetary policy as we go forward. So the important thing here, like now, is because our themes are always forward-looking. We are always looking for to align the portfolios with the right themes and how they are going to play out in the next few years. So some of the considerations here. The first consideration, obviously, a lot of questions about the bull market, whether it's a bull market continuing, would there be a correction, or there is going to be significant risks to the market, because obviously a portfolio cannot run away from the market. The bull markets right now, in-house, we have some discussion on that, and we feel that the bull markets, average length of a bull market is around 85 months, and we are hitting around 56 months, including month of January, in the current bull market. And I think there's still, at least to reach the average life of a bull market, there's still plus 20, 24 months. So this year, 2025 and 26, there's a possibility of some corrections here and there. Obviously, the way the market moves is there are corrections, and we are looking at the indicators of those corrections to align the portfolios wherever and whenever they're needed, tactically and strategically. So, but overall, in the long term, I think the next couple of years, this year and next year should be okay for the overall market and the beta space. Another question and consideration here is whether the market is fully valued. There's a lot of heartache in regards to the valuations. A lot of economists and strategists saying that markets are higher than the long-term average for the valuations. That's a consideration. So how to position the portfolios in that scenario if the markets are fully valued or higher than the normal valuations, then obviously the consideration is to look for alpha opportunities. So you have to perform better than the market rather than the beta overall, the market opportunities. Beta opportunities are the stocks are the selections for the portfolios that perform along with the market. That leads on to small cap versus Mag 7, and which, as Zeeshan very briefly touched on, also the broad asset classes are the like EM space, emerging market space, EFI space, which includes Japan versus US. So how strategically to position the portfolios, we have the tools now to position the portfolios to give an exposure to emerging markets through SPWO, which is 50% emerging markets. So how to position the portfolios accordingly. Then briefly touched upon by Zeeshan, AI, DeepSeek, and its impact on the AI structure. What are our thoughts on that? And how we feel that's going to transpire in the next 12 months of this year. In China, there are a lot of questions on the stimulus fatigue, and there's a lot of stimulus done by People's Bank of China. But there we have seen a fatigue there as well. The stocks are not really performing and in line with the stimulus provided to the Chinese economy. So again, the positioning, that would be a factor in positioning the portfolios as well. Trump's inauguration, obviously, and the first, we have seen a lot of action here, and which some of that is entertaining, some of that is not entertaining. So tariffs, deregulations, obviously, what that mean for the US stocks and what that means for the global stocks. That's another consideration in the portfolio selections, the stock selections. Some of the risks, which include obviously geopolitical risks, still Ukraine war is on. There's always Middle East, there's a crisis emerging and related to Iran as well. And which has implications like how much portfolio hedge, basically, especially for the geopolitical risks we need for this year. We've used energy as a portfolio hedge, geopolitical portfolio hedge for the last year. We had a position in ZAM, ExxonMobil. We had another position in an energy stock, which basically, in the time of crisis in the Middle East, the oil price goes up. So essentially, they provide a portfolio hedge. Inflation still, there are a lot of thoughts on inflation because some of the Trump's policies, they are inflationary in nature. So essentially, the wage pressures and unemployment numbers, we're talking with that neutral rate, what's the implication and how that's going to affect some of the stock selections we have. High dividend paying stocks being more kind of correlated with the interest rates. So if interest rates cut down, slows down, then that affects our holding there. 10 years yield, again, treasury auctions, there are fiscal policies. The US is in a huge fiscal logjam where it's an unprecedented debt there, and the sovereign buyers have started disappearing, which is sometimes pushing the 10 years yield higher. That's a risk still, which is not very obvious, but that will become obvious at certain times this year and next year. US dollar and currency themes. Obviously, one is US dollar strength is in the theme, but also the digital currency and its impact on the global currencies, plus the reverse carry trade, which is basically related to the yen carry trade. And how can that, and we saw the impact of that in as September, October last year. And that is a potential to affect any point because Bank of Japan is expected to keep raising the rates, which will strengthen yen and reduce the carry there for this particular trade. So these are some of the portfolio considerations. I went over all of them because I think just to give you guys a sharing of our thought process when we are selecting the portfolios and at the thematic level, as well as the portfolio selections as well. If we go to the next slide, that's basically a GDP growth slide from World Bank. And as I mentioned earlier, that I'm just tying up this whole thing that how does that kind of translate into the numbers? I think this year 2025 projection is still pretty healthy. It's better than last year, 2024, at the global level. Global world output is going to increase by 3.3%. Again, mainly weighted by EM, emerging markets, which are expected to contribute a lot more than the developed markets. The US, by far, considering the size of the economy, is going to be fine in both 2025 and 2026. Like they're basically 2.6, 2.7 percentage points. Some of the countries in Africa and emerging markets, they are not going to do that well. Consumption themes in those countries may not be that attractive as was predicted by Goldman Sachs last year. In 2050 economies, seems like there are a lot of things happening in the economic space which probably could delay that outcome, which they projected. Top 10 economies of 2050 by Goldman Sachs last year was included countries like Vietnam and Nigeria and some of those countries which have either bigger populations, but also a lot of natural resources like Iran, for example. That's going to take some more time. So consumption themes probably would be concentrated in the developed world more so. So that's one of the reads of my reads. And second read, obviously, from this table is that a global economy will stay intact and probably will keep supporting the corporate earnings, and that will keep supporting the bull market for the next couple of years. So that's kind of like one thought process. So next we go to the valuations, like just have a look on the valuations because we discussed valuations at the start of this process. If you look at the valuations here, the S&P 500 seems like overvalued here, and whereas the relatively better valued are the small caps, which include Russell 2000 here, and also emerging markets. So essentially that dictates our thought process here that whether should we position more to the small caps and the emerging market space here. Next slide, please. Obviously, that has to be supported by the corporate earnings. The corporate earnings wise, again, I think it's again, they're better in the valuations, but they're also better in the terms of the expected EPS growth for MSCI, EM, and Russell. So essentially, S&P is in the middle somewhere. S&P still is expected to be decent, but still, I think that some of the thought process goes to that how we should be positioning the portfolios in 2025. So based on that, then we can really look at that what the S&P 500 level potentially can be in 2025. Next slide, please. So essentially, S&P's earnings growth this year, sorry, would be anywhere between 11 to 14%, primarily dictated by a little bit more growth in the margins, but also a decent growth in the revenues here. So if the EPS for earning per share for S&P 500 is 308 or 311, where I was reading some of the notes from some research houses, and the valuation does not crater. I do not expect the valuations for S&P 500 to decline a lot. So probably I would expect it to add a 5-6% expansion here because of the AI's factor productivity growth coming to the American companies. So that really makes a case for expansion of valuations. Then as well, S&P 500 can touch around 7,000 level by the end of the 2025. So next slide, please. So yeah, this is now within S&P 500. Next thought process is the sectoral level. What's going to transpire? Which sectors are more expensive than the others within the sectors? So as Zeeshan briefly touched on, communication is one of those sectors which is seems good enough here. Energy seems undervalued, but energy is kind of like the EPS growth had been negative this year, and they're pretty good in the dividend and shares repurchase, buybacks. But as far as the earnings per share growth, that has been limited. That may change a little bit because as the drill baby drill by Trump this year, and that may increase the volumes, but that can have a negative effect on the price of oil. So I think some other sectors we have to balance this valuations with the EPS growth. Go to the next slide, which gives you a sectoral EPS growth. Um, Here, if you would see that Infotech, though they have stronger valuations, but they also have a much higher earnings growth as well. So essentially, healthcare is one of those sectors which valuations are decent compared to the 5 years level, historical levels, and compared to S&P 500, but still a decent earnings growth are expected this year as well. So communication is a good theme as well. So potentially some of those sectors which are expected to perform better in the EPS growth, and they are better valued. I think we will be assessing those sectors in our investment committee meetings this year to position and compare our portfolios that how does we fare relative to the expectations here. Double-digit growth here. If you see tech and healthcare, double-digit growth here. Industrials is a strong growth as well. In communication services, which we have to be pretty selective because there are not many Sharia-compliant stocks there. Next slide, please. So what are the sources of the returns, whether they are earnings growth? This slide actually dissects the earnings growth into the components. And the components are the dividends, the share repurchases, as well as the earnings. So essentially, tech obviously is leading in the earnings growth, and major contribution is coming from the earnings growth side. But however, energy, as mentioned, that earnings growth is pretty limited there, but there is still almost 6-7% combined buyback, share repurchase, and dividend yield here. So we potentially, there's some of the considerations, the moderate portfolios is to increase, to provide more income to the unit holders. So essentially, I think some positioning there it can be dictated by that. Besides that, I think communication services is one theme which appears again and again, and which has decent earnings growth, but also a strong dividend buyback and buyback yield as well. Consumer discretionary is a contrarian move, which we have discussed before, and we probably will keep discussing. So we should be sharing this deck with you at the end of presentation, and any questions even after that or during the presentation and after that, we're happy to answer those questions. Next slide, please. Yeah, this slide is basically, again, dissects that how much is the margin growth we're expecting to grow. And so basically it's a repetition of the prior slide. Next slide. So this is, I go forward, please. Okay. So the returns on the AI on the S&P 500 has been pretty concentrated. Top 10, but again, top 10 is, I have nothing bad. Still, I cannot say something wrong about top 10 because they are still there's economic concentration in top 7 or 10. You cannot really, obviously, we say that top 10s they're much highly valued, more richly valued at almost 29%, 29x the valuation price to earning ratio for top 10 stocks in S&P 500. And remaining stocks in S&P 500, which are roughly 450 stocks, their price to earning ratio is only 18.2. And generally, that's not the case. Basically, if you would see that both of them are higher than their long-term averages, but top 10 more so than the remaining stocks. But that's also dictated by, if you look at the R&D expenses, if you look at the free cash flows, if you look at the operating income, all of them are concentrated in top 10 stocks. So top 10 stocks are more expensive for a reason. And I think the impact of AI will keep determining, because adoption rate is much higher for large cap stocks, though, having DeepSeek or open architecture AI models will make it easier for smaller caps, so that basically can tilt the growth in the favor of some of the AIs, some of the smaller caps, plus the application stocks, and away from obviously hardware stocks and away from the power generation stocks like Constellation Energy. Next slide, please. So this is again Mag 7 versus basically it slices it even further because the previous slide was top 10 stocks, but this is Magnificent 7, which are the top stocks, top tech stocks basically, and their profit margins. I think profit margins have some more room to grow here, and earnings probably as per the adoptions, the revenues will grow as well. So combination of that and improvement in the profit margins probably, but the distinction, the purpose of presenting this slide is that the rest of 493 stocks, the difference between 493 stocks and the Mag 7 was much higher in 2024. That will narrow in 2025 and even narrow more in 2026. So that's basically the idea here. So next slide, please. So if you see that most of the productivity gains in next 6-7 years is going to come from AI, and wherever the adoption rate is higher, and as we'll be really looking at the impact of open architecture AI models like DeepSeek, which are much cheaper and makes it easier for small cap for adoption, that may increase this further. So GDP growth rate, which was presented by World Bank, that basically was implying expensive AI models and so less adoption by small caps, which by release of DeepSeek probably, or DeepSeek kind of models, would reduce the cost for smaller caps, so and increase the adoption and increase the GDP growth higher than 2.7%, which was attributed to the US for 2025. Next slide, please. So again, then coming on the factors, I just wanted to have a few words on the factors. I think quality and momentum factors are done very well. If you would, the momentum is the top one, and then the quality is this one, which has the filled in space here. So these are the best performing factors. Our portfolios are very highly tilted towards high quality stocks, which include balance sheet quality, income statement quality, as well as the cash flow quality, whereas the free cash flows is pretty much correlated to the net income or earnings per share. So those factors could keep determining the portfolio's allocation in 2025 as well. Next slide, please. Yeah, this is a slight more description on that, on the factors, different factors, when we look at the factoral tilt of our portfolio here, and just try to review them for 2025. Next slide, please. Okay, so just these are some of the thought processes here. Here, there are some negatives on the fixed income, I think, but more some positives on the emerging market bonds. So which our Sukuk portfolio, Sukuk ETF falls into. So we're still positive. I think there's a spread contraction there, which has not really transpired. Sukuks have done very well in the last few years. I think 2025 they are going to outperform AAA securities as well. Overall, in the equity space, large cap, we still have a positive feeling, probably equal weight, and small caps probably needs to be overweight. So when you're looking at the factors in the portfolios, quality still would be or should be overweight. Momentum and growth should be equal weight. US would stay overweight because of the obvious reasons: higher adoption of AI and better economic growth compared to most of the other EFI economies. But EM needs to be overweight as well, because EM's GDP growth still is far outstrips the rest of the world, a rate of around 4.2, 4.3% in next couple of years. Next slide, please. So these were some of the themes which we looked at the portfolios for 2025. There's EM, then there's a contrarian thinking when there were laggards of last year, and there's the fundamentals to support those laggards. Um, Small caps is one of those contrarian themes as well. It's compared to large caps, price to earning ratios that are almost discounted at the highest rate in the last 20 years. Power shortages in the US, we have to review this because we thought that data centers require a lot of energy here. Deglobalization, tariffs, and its impacts, we have to be very mindful of that. Space launches, vehicles, companies like ASDS, they're going to do well. Some of the contrarian healthcare themes we have in the portfolios already, like HIMSS, for example, TMDX. Consumer discretionary is one space that's a contrarian space again, but um, we have to look at that space and find some good representation in the consumer discretionary space. Satellite mobility, we have VeriSign in the communication sector. We probably can look at some of the mores which can tend to connect the mobile phones to the satellite, which Elon Musk is kind of putting on that satellite internet out there. Uh, Cybersecurity, we have some peripheral themes in cybersecurity, but we probably can add more there. I think there's a potential as the AI expands, then need of cybersecurity expands as well. Our robotics and automation, we have VRT, which has done very, very well for us in 2024, and I expect to keep it doing well in 2025 as well. So this is roughly the thought process here, and there's a last slide which I purposely am not going over. There's a tactical and strategic thinking here process with some of the opportunistic trades we have, like snow. So I'm not going through the detail of there's some stocks which sold because of the target price discipline, as mentioned by Zeeshan as calm. Um, we run the correlation tables for the core part of our portfolio, which is very less correlated. So essentially, uh, that's improved the risk ratings of our portfolio. Like in the times of crisis, in the times of swoon, the portfolio probably would end up doing better than the individual components because of this correlation, which is pretty low. So I leave it at that. So we shall be incorporating all these thoughts I discussed in here, and the purpose of discussing them is to give you guys a peek into our process here, our investment process, and we discuss it weekly, and all these based on these thoughts, and we'll keep aligning the portfolios to achieve uh, uh, as good as returns, probably better than last year even uh, for 2025. So I would just close it at that point and hand it back to Zeeshan.
Thank you, Irfan, for the very insightful information that you provided, and I'm sure it's very helpful to a lot of the attendees this webinar. We have opened the floor for questions, so you should see a question and answer box in which you can type out your questions and we'll answer them as best as we can. I do see a question here, and Irfan, perhaps you can answer this.
Yeah, I see
How
a question. I can answer live basically. Some of those questions I can answer in the chat as well. If Zeeshan, you want me to go on the live or chat?
No, you could answer this one live. I'll answer the next
Okay.
one. How are the tariff talks with the US going to impact the portfolio?
Okay, so thank you, Ahmed, and it's a very good question. Tariff talks are obviously there's a thought process that Trump is using that as a bluster and to force the deals and to achieve some concessions in the trade for the U.S. So essentially, that's benefits within the U.S. There's still it's playing out, but within the U.S., obviously, it benefits to the companies which have a stronger footprint within the United States as compared to the footprint outside the US. So essentially, we already was mindful of that thought process in 2024, and because there were some sanctions on China in 2024, but probably by expanding that, then obviously that's another consideration for the portfolio in 2025.
The next question I have is, how did the growth level portfolio perform in 2024? Um,
Yes,
we,
Zishan, you can take it.
I can provide a very general answer, but if you have specific questions with regards to your portfolio, please do get in touch. The numbers that I provide are for general purposes and based off of Bloomberg models. So it's not necessary that every client would have had these exact same returns. But in general, our growth model performed about 15.13%, which is still very good considering the target rate of return for our growth models on an annualized long-term basis is actually 9%. And the fact that the outset allocation of the growth model is different in comparison to the S&P 500, with a large allocation to the sukuk as well as other allocations like real estate as well as the global ETF that we do maintain. So I hope that does answer your question. Do we have any more questions? The floor is still open. Please do feel free to ask any questions that come through your mind. Our contact information is also on the screen in front of you, so feel free to note down our email addresses and reach out if there is any question that we can answer afterwards, which may come across your mind. At the same time, if you do want to discuss any of
We
your
still have a couple of minutes here. Basically, we can, there's
yeah,
another question from Brother Ahmed. Okay, that's a comment. That's not a question.
yeah, absolutely. Feel free to reach out. To discuss any of your personal situations, your personal portfolios, and we'd be more than happy to help you. If you do have an advisor that you're already working with at ShariaPortfolio, please do reach out to that advisor of yours directly first, and then we can set something up, inshallah. Do we have any other questions? We still have a couple of minutes if anybody does have. We do have a question here. If you are anticipating shrinking of the Mag 7 with the rest of the stocks in S&P 500, how will that affect the overall return of the S&P 500 index? So before I actually pass this on to Irfan, I'll just take a quick shot at it, and then Irfan would like to get your insight as well. Our exposure to the Mag 7 companies within our portfolios is actually not that great with regards to our individual holdings. Even if you look at the laggards and performance, the drivers of our portfolio, you'll note that a lot of them are actually not part of the Mag 7. We do have exposure to the Mag 7 through the ETFs that we hold in our portfolio, like SPUS and SPTE. But we manage that level of exposure to the Mag 7 through the use of our ETFs. And we don't have much of an individual position right now as it stands in those positions specifically. Irfan, do you want to add anything to that?
Yeah, no, that's pretty good actually. And I think the part of the question is kind of those both these questions by Brother Imtiaz, they're connected to each other. So I would say that, that contraction or shrinking of M7 with the rest of the stocks is not the shrinking in the weight. It's basically the small caps are 493 stocks. Their earnings growth is expected to catch up with the earnings growth for Mag 7. In 2024, the Mag 7's difference between Mag 7's earnings growth and the small caps and the rest of 493 stocks earnings growth was much higher. And if you look at that slide, once deck gets shared, you probably will notice that slide, the difference between 493 stocks and the 7 stocks earnings growth was much higher in 2024. That is going to be expected to shrink that difference. But that doesn't necessarily mean that the share of the Mag 7 stocks or the weight of Mag 7 stocks in the overall S&P 500 may shrink. And secondly, the second component here is the valuation price to earning ratios. Price to earning ratios, because of the impact of the growth estimates, I think we still expect that there's not going to be meaningful contraction in the price to earning ratios of Mag 7 in 2025 at least. However, that small caps valuation, probably there's a room for it to expand much more than the Mag 7. So the price returns for Mag 7 may be 493 stocks would be higher than the Mag 7. So basically broadening the rally, broadening the bull market. So that overall impact on obviously performance of S&P 500, the contribution from 493 stocks in 2025 will be higher compared to 2024. And price gain contribution by Mag 7 in S&P 500 will be lower in 2025 compared to what they were in 2024. So essentially, it's a shift from Mag 7, the performance contribution for S&P 500 from Mag 7 to the 493 stocks, remaining 493 stocks. That's the expectation. So what does that imply for S&P 500 overall returns? I think that's really baked into the overall expectation of overall EPS growth of around 14% for S&P 500 plus a little bit of valuation expansion. So roughly maybe 23-24% returns in 2025. That I'm just saying it off the cuff because it's not a calculated number, but that's what I can say is that around 14% growth in the EPS, including Mag 7, including 493 stocks, plus around maybe 6-7% contribution from expansion of the valuations overall. So that if you add that up, that's basically comes out to be 21 to 22 to 23% growth in 2025. Although I would warn you guys that consensus growth is around 10-11%. That's the consensus estimate for S&P 500.
So I hope that did answer your question. I don't see any further questions in there. Okay, we do actually have one more question. What are your plans to launching a Russell 2000 or IWM-based ETF?
That's a great question, and I think there are thoughts for the new products, and obviously the small cap is among one of Sharia compliant small cap is one among those thoughts process during 2025.
I don't see any further questions. So once again, our contact information is on the screen ahead if you want to go and take it down right now. Feel free to reach out to us and inshallah we'll be able to help you. Otherwise, thank you so much to everybody for joining the webinar today. I hope you did find it insightful and helpful. Appreciate your time. Thank you, Irfan, for presenting as well. And we look forward to seeing you at the next webinar, inshallah. Take care, everybody.
All right, Assalamu alaikum, everyone. Thank you very much for participating this evening.